The income machine. It's time to check in on our income machine for MicroStrategy and Nvidia. The income machine, of course, is the wheel strategy. We've been in the selling puts phase of this strategy thus far. Now, before we get into it, smash that like button, subscribe if you've been with us a while and haven't done so yet. Check out the Trade Cave store, link in the description, as well as the channel bio. Let's get into the income machine. So we've been doing this for about 6 weeks now, and these are the totals down here. 2,883. That's how much money I've made off of these two tickers selling puts so far in terms of how much premium I have collected. I do have currently two puts open. You can see here the $757 one for Nvidia and the $2,064 one for MicroStrategy that are currently open that I am have not closed yet. So those may not come out to being 2,883, but thus far I've collected that much premium. Okay, that's basically how this is working right now. So that comes down to how much per week. Let's see, 2,883 divided by 6, $480 per week between the two of these so far. Now that does include that big market crash on August 5th, because I was in at least I was in Nvidia at that time, and that you can see was pretty rough. But and then also a pretty nasty crash on August 26th through September 3rd for MicroStrategy that we had to dig out of as well. Anyways, per month though, so far per month, we've been collecting 1,922. Now I know I titled the video "Make $2,000 off of $25,000." 1,922 is pretty close. So don't fault me for that. No one's looking for a title that says make $1,922 in a month. Like 2,000 is a nice round number there. Forgive me there for that slight disparity of $78. Anyways, we're coming back in here. So let's look at how this has been going so far. So we started with MicroStrategy on August 9th. We sold a put for $327, and since then we've been selling for between $245 at the low end and on the high end, $2,064. Now that one for $2,064, that one was a month out, and I sold that for a month out because of this big drop right here. This big drop, that was, let's take a look here on the right side of the screen, that was a 25% drop in a matter of a week, like a week and a half. All right. So I sold that first put. That was a 148 strike up here. It was a 148 or a 147 strike up here on this inverted hammer up there, which is also known as a shooting star, something like that. It was a bad candle. I shouldn't have done it. And as you can see, as soon as that candle printed, it just came down, 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 down from there. Now, the very next day, you can see that one was August 26th. That's when I sold that one right here. August 26th, when I sold it right there on this one. August 27th, I rolled. I rolled it down to a 142. And you can see on that day, it went all the way down to 138. Okay. So the reason I did that roll was because this was a weekly option, right? It was expiring that Friday. This was on Tuesday. And I was already in the money so much that early execution was a threat because I sold it for $387, meaning I had a padding of $3.87 from 148. And it had dropped all the way down to 138. That was $10, significantly past my safe zone for early execution. So I rolled it out. I rolled it down to 142, and I rolled it out about 2 weeks to September 20th, I believe. And then it continued to fall, and it fell to 131. It fell to 119. It fell as low as 113. But on that second one, I actually had $10 of padding, of safety net from that 142 strike. So I could go all the way down to 132 before I was at threat of early execution. And the reason I didn't sell it immediately the next day again on the 28th and the 29th and the 30th was because I pushed it out 2 weeks. So I had 2 weeks of time. So the threat of early execution really wasn't coming in until midweek, the final week of the contract, like Wednesday of that final week, which would have been this coming week now. So I still had some time there, but it kept falling and falling and falling. And then on September 3rd, we had that 7% drop. That's when I decided to roll again. okay, because I was $20 in the money, basically, over $20 in the money on this, and expiration was coming up in about a week and a half. $20 in the money was basically if the contract were executed at that time on September 3rd, which was significantly before the expiration, but I was so far in the money that it was profitable by $1,000 for an early execution. So if that contract were executed early, the executor of that contract basically would immediately make $1,000, which is not a bad return for basically no work. So it was a bit concerning there. So I decided to roll, and I rolled it this time out to October 18th. And I rolled it out to October 18th. I paid so 2,036 to get back that put I had sold for 1,035. So I took a $1,000 loss on that. Basically, I realized a $1,000 loss, and then I sold a new put all the way out to October 18th for $2,064, which basically put me back in the green by about $1,000. Right? You can see all the action here. Right at the time of August 26th, I was up $1,188. Okay. And then on August 27th, that went from 1,188 to $459 of positivity. And then as soon as this sold, I was down by 1,500 bucks. All right. And then I sold this one and I was up another 487 on top of this 1188. So that's how I'm landing at 1288. That's basically this 1288 is the addition and subtraction of all of these all the way down since August 9th. And that's how I got out of that hole. That 25% drop was basically I stayed calm and I waited for times that I felt were strategic enough to do a roll. And a roll is when you close out the contract that is currently open, and then you immediately open a new contract for a different strike price, a more advantageous strike price at a further date in time. Because options, you are paid for time. So if you're buying options, you're paying for time, right? If you're selling options, you're selling time. So that's basically how that works. And the further out you go, the more expensive it is. So if you're selling options, the further out you go, the more money you will collect. And it also allows you to lower that strike price. So if I stayed closer to that strike price, I would have had to do a much higher strike in order to get back that $2,000. So I had to go further out in time in order to do a lower strike that was closer to the current price so that I could get out from underneath that. And I think we'll do more of an in-depth video on how that would look and work here in the future. I need to think about how I can like visually display that so it makes sense and it's not all just super confusing. If you're confused, go ahead and make a comment there, and I'm going to think real hard about how I could visually represent this sort of scenario in a way that makes sense in a visual format. So that's just me explaining it, right? All right, so current, and then Nvidia. So let's take a look at Nvidia. So Nvidia, we also had a bit of a disaster happen on Nvidia. That was August 6th, August 5th, sorry, August 5th. So I sold my first put on Nvidia on January 30th. I bought that back for $60 the very next day because it went from down here 103. So it went from 103 all the way up to 118 in one day. So I sold that, made almost $300 in one day. All right. Then I went back and sold another one for $295 on the 31st. And the very next day, actually the same day, the same day, since that was a big drop day, they went down 6% that day on August 1st. Right. But I managed to buy it back for less than I paid for it, same day. And then I waited until August 1st, right, and did another one because we had a little green day. So I did another one for 287. Bought that back for 600 bucks. I don't know why I did it that organized that way or how that happened. Bought it back for $600, so I was down 300 immediately on that, and sold a new one for $814, all on 8/2 on the 2nd of August. Okay, and then on Monday things got interesting. I had to buy back that $800 put I had sold for $1,444, and then I sold a new one for $1,450. And that was, let's take a look. Let me see what that one was exactly. It's going to take a second. I have to load everything on my phone here. Okay, Roth, history. And that one was on August 5th. Let's go see what happened on August 5th in this account. It was, okay, so I sold a put. I bought back my $102 put that I sold on August 2nd, and I sold a $98 put that was from August 30th all the way out to this October 18th. Okay, all the way out to October 18th. And then I ended up buying that put back on August 13th. Just a couple of days later, less than 10 days later, I ended up buying it back for $459, basically making this a zero-sum situation. And then I went into on August 13th. On August 13th, I sold a new put for $111 strike price for September 20th. So I lowered the time from October 18th to September 20th and increased the number. So I went from 98 to $111, and I sold it for closer to the current time. All right, that's what I did there. And then I went and bought that back on August 15th for $403, making about a little over $300 there, and then immediately went back and sold one for $654. Okay, closed that one out a couple of days later because it wasn't going super well for a $1 profit, and then sold the exact same put for the exact same date later that day for a $40 gain there to the $690. And I bought that back on the 29th for $413, netting another $200. Okay, and then on the 3rd, I sold one for $564, which turned out to be a mistake on September 3rd. This day right here when Nvidia went down 9.53%. And then I ended up buying that back for almost $700 and then selling another one immediately for $757. And I believe that was, yeah. So I sold the same put. No, I sold a put one strike higher. So it was 108. Originally, it was 108. I sold it for a new one for 109 and pushed it back by 2 weeks, getting me that extra 60 some odd dollars there from that 757. So I am doing a lot here. So I'm managing this a lot, but that's because I'm working with some pretty volatile stocks that are moving a lot. So I am getting into situations where I need to roll, mostly because I am selling puts pretty close to the money. All right. And we've been seeing days lately where these things are up and down by, double-digit percentage points here. So, we're moving by double digits on some days with these. So there are situations where I end up in the money so much that early execution is a threat. So it's time to roll. Or I see that selling a different put was significantly more advantageous to me at that time. So I end up rolling it out to do that instead. Now, there's a lot more management than you're probably thinking when we were talking about the income machine. It's not always a set it and forget it. It can be a set it and forget it sort of situation. But I'm not mad about making $2,883 in 6 weeks, even with all of this management that I'm doing here. And you can see just how much it's going back and forth, and it is kind of a lot happening. But I'm not too concerned. Right now, I am actually on both of the current puts that I have. So the Nvidia one that I sold on September 3rd, it is a 108 put, expires October 18th. I am up 62% on that already, meaning I have already gotten to a situation where $472 of profit, I could take $472 of profit out of this $757 right now if I wanted to do that on Monday morning. So that's not bad. 62% profitable already on that one. Nice. Let's go look at the MicroStrategy one real quick. Where am I at here? So the MicroStrategy one is a $134 put. Current price is $141. That's nice. So a $134 put, also expiring October 18th, and that is currently 52.24% profitable, or $1,078 profitable on that right now. If I were to take that, so that would lower this by a little bit, 174. So that would cut this in half, make this about $600 if I were to close it out on Monday. I'm not going to close it out on Monday. I'm going to close it out when it's a little bit more profitable. I think around 80. When it's 80% profitable, I'll be closing it out and then looking for that next moment in time where selling a put is advantageous on these two. So on both of them, when they get to about 80%, I'll buy them back for 20% of the value that I sold it for, and then I'll be looking for the next most strategic point in order to sell another put. And that is how that's going to work. And so I'm pretty excited right now. I've made almost just under $2,000 per month right now, or almost $3,000 in 6 weeks off of the income machine selling puts on MicroStrategy and Nvidia. Now, when price gets to a point where I feel like it may start to like come down, but not like kind of grind down a little more slowly, a little less with a little less volatility. At that point, I think I'll let myself be assigned these shares for both MicroStrategy and Nvidia, and that's because let's go over here, and that's because if we come in here, make this bigger, all right, straddle these, and let's go about a month out, October 25th. Let's go about a month out. Okay, if you want to sell a month out put or call on MicroStrategy, just a month out. We're doing MicroStrategy by the week. Excuse me, we're doing MicroStrategy by the week, not the month. Let's do MicroStrategy by the week. 1 week out, you go a little bit out of the money. You're looking at $500, right? $500. Whereas with the put, I wanted to be a little further out of the money than that because I want to have a little bit of a buffer there. I was collecting between $400 and $250 per week. On the call side, yeah, I could be doing 457 to 550 in a week, every single week. So it could be $2,000 a month just on MicroStrategy once I get onto the call side of things. Let's look at Nvidia. Let's see how Nvidia is for a month out options. Let's see. Let's go here, straddle. We'll go October 25th. And this is just the Yahoo Finance options tab for these tickers. Okay, let's take a look here. So if we're at a point where I'm feeling comfortable that Nvidia will likely grind down kind of more slowly here for a little while. I don't think that's going to be next quarter, but let's take a look here. I'd be going something like 3-4, yeah, like 3-4 out of the money, 650. So I could collect about 650 per month on Nvidia using about $12,000 of capital to do that. The puts are actually not worse. They're actually better. The puts are actually a little bit better right now. So I will continue to sell puts right now. If you look at three out of the money, 117, we're at 676. I think right now though with Nvidia, I'd probably be looking to sell like a 110 or like a 112. See, 110, 112. So about $400 for a 110 or like a 112. We're looking at $500 for a month on that. And if I were to sell a call off of these, I'd probably set it right up here. Much like, see, I'd set it right up here at the top of this this flag that ended up dumping right here between August 16th and August 29th. That little area right there. I'd set it just above that, like 130. 130 is a pretty tough area right now, and that would get me $400. So like about the same right now. So I'm pretty comfortable just doing puts because puts leave me with cash that I can do other things with if I decide I don't want to do this position anymore. And things like what I'm going to talk about in the next video, which is the next stock I'm looking at for potentially doing an income machine, a wheel strategy, if you will, doing a wheel strategy on. So far, this is the wheel. We're 6 weeks into a wheel. We've made $2,883 off of 2 tickers using just under $25,000 of capital to run these wheels on these 2 stocks. We've had a couple of pretty catastrophic situations happen while we were in these positions. One with Nvidia on August 5th, which everyone felt that was pretty rough, and one with MicroStrategy where we lost 25% in like 5-6 days as Bitcoin fell here, going into the last week of August into the first week of September. And we're coming out smelling like roses, I think. Anyways, that's all I've got for you today. Please like, comment, subscribe, share this video. Check out the Trade Cave store, link in the description, as well as the channel bio, and have a profitable day.